I think a really interesting framework with risk management as well is questioning like, what is the potential upside? So what's the potential upside? What's the potential downside? And can I live with the downside? And that's kind of where your individual decision-making comes into place, because you can figure out the math of like, what are the extra costs, right? In this example, it's $20,000
Call it 20 grand.
extra.
Yeah. We'll call it 20 grand. Yep.
You can determine which is going to be the best upside for you, but it really comes down to the potential downside and can you live with the downside? And I think that's why you and I have a bias towards that middle band of asset diversification. So it's not all eggs in one basket, and it's not a few eggs in many, many baskets. It's a handful of eggs in a handful of baskets, because the potential downside to all of those options, that middle band is where we sit the most comfortably, because if something happened and that market kind of turned and that particular asset didn't work, if that is 1 in 5, we are comfortable with that risk and being able to manage that and deploy and respond how we need to. Versus if you might have a better upside, maybe in one asset that has a higher purchase price. But if that turned, what is the potential downside of that? Can we live with the downside of that? Yeah. And that's usually the decision that you as an individual investor have to process. And that's usually why people end up with those kind of spread, diversified across different locations. And people are buying like $20,000, $100,000 assets very frequently, as opposed to people buying maybe between $2 million
asset.
Yeah, or like between 5 and 8, kind of $400,000, $300,000 assets. Like that's the most common, because that's generally where people feel the most comfortable with the downside.
It's got a different risk profile in the market too, and you kind of touched on that earlier. Like, so in that kind of like $250,000 to $600,000 price point, that's a really accessible market, right? It's affordable for most people. It's attractive to most people. If there's a economic disruption, people will downgrade, not upgrade. Like there's all of these kind of things, right? So that's the middle band where you're going to get, if you think about it on a bell curve, that's where the opportunity is for most people. So you've got the highest concentration of potential buyers and all of that kind of stuff. So it is actually the lowest risk band of property assets. Yep. So in that kind of general price range. So there's that. So that's a risk management piece in and of itself, right? And interestingly, in the example we're using of like, so one $600,000 property versus two $300,000 properties. Let's say there's a $20,000 difference, right? Essentially, what you would be saying is, if you wanted to buy the two $300,000 properties, is I'm prepared to pay a $10,000 premium per property to reduce my risk by 50%. It's almost insurance, like if you think about it like that. And if you then wanted to just get a little bit more granular even further and say, this is going to cost me $10,000 today, but over 10 years, which could be, we use that as the life cycle of the property, right? It's going to cost me $1,000 a year to be 50% diversified, like per property, right? To be fair, right? So then does that then change the perspective on risk? I mean, I think so.